Thanks, Mark, and it's a pleasure to be here, and it's a pleasure to be talking about equity markets. And haven't we had an impressive run on the stock markets? And that's despite we've had pandemics, we've had the GFC, and more recently had rising interest rates. And the market's been able to climb this wall of worry, and now we're trading near all-time highs. And to that end, we've had a look at how Wall Street experts pick the short term, because picking the short term in markets is fraught with danger. Now, what we've done is we've gone back 23 years to have a look at how they've done. Now, I must say the results are not pleasing. Now, to help us with the results and to sift through those results, we brought in an iconic Queenslander here, Ray Wilkie. Now, if you're a Queenslander, or you were born in Queensland, you'd know who Ray Wilkie is. He's a 40-year veteran of weather forecasting in Queensland. He's right up there with the likes of Steve Irwin, Greg Norman, Cam Smith. What I didn't appreciate when I was young is how hard weather forecasting is. But I must say that Ray Wilkie did a far better job than these so-called Wall Street experts. So we went back. How good were they 1 year forward with their forecasts? Here are the results. 80% of the time, they said the market was going up. Fair enough. They got the direction right 50% of the time. Oh my God. And then the forecast error was 16%. So if you think of markets going up 6 to 8% per annum, being out by 16% on average is a lot. So it's fair to say that trying to pick the markets in the short term is a mug's game. So how have the markets gone in the short term? So we can see here, S&P 500 is up 20% to the end of July. Pretty great return. Where's it come from? Well, has it come from earnings upgrades? Earnings upgrades over the same time were up 1%. So 95% of the move in the S&P has come from noise. And what do we refer to as noise? That might be AI, might be short-term interest rate moves, it might be wars. The point is, it's very hard to predict short-term movements in the market. Fortunately for investors, the long term's a little bit easier than that, and it comes down to fundamentals. Over the last 20 years, we can see the markets are up 310%. So big move in the market. Over the same time, the last 20 years, we've seen earnings are up 270%. So we've got 90% of the move in the S&P over the long term is from earnings fundamentals, only 10% this time from noise. So what does that tell us? That tells us that long-term earnings drive share prices. Long-term quality earnings drive share prices. And at Solaris, we believe that's the key to investing. At Solaris, we're a bottom-up Aussie equities manager. We've outperformed in 17 out of the last 23 years. We offer our products across 3 strategies: Solaris Core Fund, Solaris Long Short Fund, a 130-30 product, and the Solaris Income Fund. All strategies use the same proven process and the same team. Now, what I'm going to talk about today are 3 things. So what are quality earnings? So we talked about earnings and quality earnings driving share prices. I'm going to talk about quality earnings. And quality earnings are earnings that are backed by cash flows. Secondly, I'm going to go through a couple of case studies of companies that have had poor quality earnings. And then thirdly, a couple of companies in our portfolio that exhibit those quality earnings. So let's look at quality earnings. So what are quality earnings? Quality earnings are those earnings that are backed by real cash flows. But where do company management steer us in that process? Quite often, they're getting us to look at accounting earnings, which don't represent quality earnings. They steer us towards EBITDA. They steer us towards EBIT. And there's a number of factors that are not looked at that are relevant to share prices. And these factors are things like interest costs, CapEx, depreciation, tax. They all drive share prices, and quite often management aren't directing us in that direction. I really like that quote by Warren Buffett down the bottom, and it makes a lot of sense. And I won't repeat it, but I'll paraphrase it. He is saying you're crazy if you don't look at interest and tax. And he's exactly right, because they matter for share prices and they matter for earnings quality. So, the first case study, Domino's Pizzas. Everyone knows Domino's. My kids love Domino's Pizzas. They're hugely popular in our house through COVID. Now, Domino's was a COVID beneficiary, and you can see on the chart there, up on the screen, pretty impressive performance. And I will draw you to the red line in the chart. That's a share price chart. And remember back when I was talking about short-term prices and how there's a lot of noise? During that short term there, the shares went from $40 to $160, so up 250%. Over the same time, we saw earnings forecasts being upgraded by 5 to 15% depending on the year that you're looking at. So earnings aren't particularly driving that share price. There's something else driving that share price, noise. And during that time, while everyone else was buying, we were shorting for our long short product. That was the first thing. The company was looking very overvalued. What gave us a bit more confidence was at the AGM in November 21, when the company started talking down top line growth. The market was really looking for strong growth to justify that share price. The shares started coming off. And then again, the third point is at their result. In the first half, what did we see there? So we saw a deviation for the first time from their earnings in blue, their accounting earnings, from their cash flow earnings. And remember I said how important earnings quality is to driving share prices. So we saw that deviation, and that gave us the confidence to stay short Domino's through that period. Now, another factor that has been particularly important during this reporting season is interest. And there's been a lot of focus on REITs for the last 12 to 18 months, but more importantly, the rest of the market has started being hit, and David talked about that today. But big cap stocks such as Amcor, Endeavour, Horizon, companies with a lot of debt were surprising on the upside in terms of interest costs. They were all down. Interest does, and those factors do drive share prices. The second case study is Cromwell Property Group. Small property trusts, probably not well known by people in the room here. They have a 1.3 billion market cap, 2.3 billion of debt. With that much debt, you're potentially going to have a problem with interest costs. And we can see here on the slide, interest costs have doubled in the last 12 months, and we expect them to continue to go up. That's okay if you've got a top line revenue that continues to grow. But in the case of Cromwell, they've got limited room there. So that potentially places pressure on your earnings, your dividends, and your returns to shareholders. But what made us go short, again, is earnings quality. So the blue line is staying up there, the red line is the cash flow. The cash flow is what is available to pay the interest and to pay shareholders in terms of dividends. We saw that earnings quality deteriorate, and we were happy to go short. So you can see the importance of earnings quality. The next case study talks about CapEx, and remember that was another factor that drives share prices. Now CapEx is not an accounting earnings, and CapEx, or capital expenditure, is something that all companies need to spend in order to maintain dividends, particularly big with resource companies. And during reporting season, they were the sector that got hit the most in terms of CapEx revisions up. So a lot of surprises in terms of CapEx. The example I want to talk about today is BHP. You can see BHP, the bar chart is their CapEx over the last 10 years. 2016 to 2023, they're on a CapEx holiday. And as investors, we loved that CapEx holiday because it meant special dividends, it meant off-market buybacks and higher payout ratios. but every good party has to come to an end. BHP, like a lot of other resource companies, have catch-up CapEx to do from the last 7 years. In addition to that, these companies are committed to net zero for 2050. So there's a lot of spend that has to go into decarbonisation. So with the two of those factors, we see much higher CapEx going forward, and we believe it's probably going to be even higher than what you can see on the chart there. So the implications for investors are, the blue line is your accounting earnings. The red line is your cash flow. Your cash flow is deviating from your accounting earnings because of that excess CapEx that is not in your accounting earnings. So that's really important. And what you can see over on the right-hand side is your payout ratios. So we've seen 60 to 140% over the last 8 years. For the next few years, we expect 40 to 60. So lower returns to shareholders. We're all hoping that commodity prices stay up, but lower returns and lower payouts for shareholders. So that's enough doom and gloom. Let's look at a few quality companies that we've got in our portfolio. So 2 companies, and they're both growth companies, Cochlear and LTM. So LTM does software for printed circuit boards. Cochlear does the ear implants. Both companies are strong leaders in their industry, strong pricing power. They both have got good balance sheets and good management. And they've both had a history of strong revenue growth and earnings growth. And we expect that to continue going forward. So that's your accounting earnings. What do we see when we put up the cash earnings there? They're all very close. So those 2 companies have shown over time that they have very strong earnings quality. They expense CapEx. That is really important that you see that, and that gives us the confidence to invest in these companies. So what is the bottom line? What really matters? Earnings drive share prices in the long term. Quality earnings drive share prices. But as a fundamental manager, you need to do the work, particularly in those factors that aren't told to you by management. At Solaris, we're a bottom-up fundamental stock picker, and quality earnings is part of our process. We've got 3 funds, the Solaris Core Strategy, the Solaris Long Short, the 130/30 product, and the Solaris Income Fund. And when we go back to that last slide, those 2 companies that are in the portfolio, those growth companies, we hold them in our income fund. Our income fund is not just about clipping the ticket and having the highest possible yield, it's about growing the capital base. So we're very happy to have growth companies in that portfolio. Thanks for the opportunity today. I'll be here after the presentation if you want to have a chat. Otherwise, talk to your Pinnacle representatives. Thanks, Mark.